If you think the dot-com bubble was irrational, buckle up. That was amateur hour compared to the lunacy I'm seeing with AI. At least in 1999, people pretended to understand what they were buying. Today, they don't even bother with the pretense. Ladies and gentlemen, I've watched a lot of manias in my lifetime. Tulip bulbs, dot-com stocks, crypto tokens, each was a masterclass in human folly. And now we've arrived at the latest spectacle, artificial intelligence. Don't misunderstand me. AI is a remarkable tool, a genuine leap in human capability. But we have a long-standing tradition in America. Whenever something truly useful comes along, we immediately turn it into a circus. The country can't help itself. Investors don't ask, "What is this worth?" They ask, "How high can I push it before a bigger fool takes it from me?" The dot-com boom at least had the decency to explode quickly. This AI boom is metastasizing across everything: valuations, headlines, corporate mission statements, and dinner parties. Most people talking about AI have no idea what it is, but that's never stopped a good bubble before. I'm not predicting the end of civilization. I'm merely saying that unearned optimism has an expiration date, and when the bill comes due, it will be quite a bill. But in the meantime, human psychology will do what it always does: exaggerate the impossible, underestimate the practical, and gamble away fortunes chasing mirages. So if you want my advice, embrace the technology, sure, but don't lose your mind. Don't assume that because a few companies will dominate the future, every company with the letters A and I in its press release will be worth a fortune. That's not investing, that's stampeding. And let me remind you, every stampede ends the same way. ChatGPT said, Keynote 1 insists on a truth that people are forever trying to wiggle out of. Technology, no matter how brilliant, does not grant immunity from stupidity. You can wrap nonsense in fancy algorithms, you can sprinkle it with jargon, and you can even convince an MBA that it's transformational. But at the end of the day, stupidity has a 100% success rate in destroying value. The world is suddenly filled with people who think that if you attach the phrase "powered by AI" to a business plan, it automatically graduates from ridiculous to revolutionary. This is the same delusion that fueled the dot-com mania, when putting .com at the end of a company name magically multiplied its valuation by 10. People believed that a shiny new domain name exempted them from having a real business, real customers, or real profits. Now, AI has become the new spell word, and the more nebulous the model, the more excited the crowd becomes. It's astonishing how quickly human beings surrender their critical thinking the moment a technology appears complicated enough to make them feel inferior. But superiority or inferiority has nothing to do with it. A business either creates value or it doesn't. If your company can't survive without storytelling, buzzwords, and heroic assumptions, no amount of machine learning is going to save it. This foolishness happens because humans love shortcuts. They crave the illusion that someone, somewhere, has discovered a magical formula for wealth that doesn't require discipline or reasoning. With AI, they think they've found it. They want to believe the algorithm will think for them, invest for them, and rescue them from mediocrity. Unfortunately, the world has never worked that way. Technology amplifies strengths and weaknesses. It doesn't replace them. Give a disciplined thinker an intelligent tool, and the results can be remarkable. Give a reckless speculator the same tool, and you just make bigger disasters, faster. The dot-com bubble didn't collapse because the internet was useless. It collapsed because people abused it as an excuse to behave irrationally. AI is far more powerful, which means the explosion from misusing it will be louder. Human folly doesn't become wiser when you give it more processing power. It just gains the ability to scale its mistakes. The reason this truth refuses to sink in is because hallucination is more attractive than diligence. It's more pleasant to fantasize about being early in a gold rush than to patiently evaluate whether there's any gold in the ground. And this current frenzy rewards hallucination wonderfully. Every pitch deck looks like a fever dream of exponential growth. Every founder claims to have a revolutionary model. Every investor pretends to understand the technology deeply enough to justify gambling client money. This behavior is practically a tradition during technological booms. People are so desperate not to miss out that they abandon the one skill that would protect them, the ability to say, "I don't understand this well enough to bet on it." Refusing to admit ignorance has bankrupted more people than any recession ever has. The painful irony is that the true value of AI, real value, not imaginary, doesn't need frantic speculation to prove itself. The technology will genuinely transform industries over time. It will make many things cheaper, faster, and more reliable. It will create efficiencies that compound like interest. But that slow and steady march of progress is boring to the mania-driven investor who wants fireworks right now. And because they can't accept that meaningful progress takes decades, they chase shortcuts disguised as revolutions. They buy into startups with no revenue, no moat, and no coherent plan, other than the hope that something magical will happen because we're using AI. That isn't investing, that's hoping for divine intervention. And markets are not known for helping those who rely on miracles. You'd think after watching bubbles inflate and burst over and over again, people would learn. But they don't, because they're human. They keep believing that this time the rules have been suspended. They convince themselves that technology can rewrite the laws of economics. They cling to the idea that maybe, just maybe, there really is such a thing as a free lunch. And every generation discovers the same universal truth the hard way. When you mix ignorance with excitement, you get a bubble. And when the bubble pops, technology gets blamed instead of the very people misusing it. The internet wasn't the villain of the dot-com bust. Human behavior was. AI won't be the villain of the coming correction either. The villain will be the crowd, stampeding without thinking, intoxicated by the fantasy that intelligence can be outsourced. This leads naturally to the second keynote, because when the crowd loses its mind, the first victim is math. Valuations, which are meant to anchor businesses to reality, become optional. People replace arithmetic with storytelling, and storytelling is the world's most popular narcotic. In the dot-com era, investors claimed that profits didn't matter, eyeballs were the new metric. They treated the P/E ratio as an embarrassing relic from a bygone age. And then, when the crash came, everyone suddenly remembered that businesses are supposed to make money. Now, in the AI frenzy, we're witnessing the same intellectual amnesia. Valuations are inflating to levels that require suspension of disbelief. Companies with no sustainable revenue model are being valued as if they've already conquered the world. This is how bubbles behave. They reward enthusiasm and punish arithmetic. But arithmetic always returns, and it returns with a vengeance. The great thing about math is that it doesn't negotiate. It doesn't care about sentiment or hype or how many thought leaders endorse the technology on social media. It doesn't bend just because the crowd has convinced itself that exponential growth is inevitable. If a business is priced for perfection but delivers reality, which is what almost always happens, math does what it always does. It crushes delusion. The market correction is not the moment when everything goes wrong. It's the moment when everything stops being wrong. Valuations should reflect cash flows, competitive advantages, capital efficiency, and durability. But in a bubble, those factors are treated as old-fashioned. People prefer to imagine astronomical future profits and then justify the present price tag with those fantasies. This is not analysis, it's daydreaming. The larger the fantasy, the larger the price. And the larger the price, the more brutal the reckoning. If you ignore math long enough, it will find you, and it will not be gentle. What's happening today is a perfect storm. Enormously promising technology combined with widespread ignorance, amplified by greed. Investors extrapolate too much from too little. They see a few companies executing brilliantly and assume the entire field is unstoppable. They see impressive demos and assume commercial dominance is just around the corner. They forget that markets don't reward potential, they reward realized value. The world is filled with technologies that were revolutionary in theory but disastrous in practice. AI will succeed in many areas, yes, but that doesn't justify valuing every AI-related business as if it is guaranteed to be a winner. There's another psychological flaw at play. People hate missing out more than they hate losing money. During bubbles, the fear of watching others get rich overwhelms the fear of going broke. This leads to absurd valuations that look rational only because everyone else is behaving irrationally. When you ask investors why they're buying at such lofty prices, they give answers soaked in optimism but devoid of math. They talk about runway, total addressable market, industry disruption, and other lovely abstractions. What they rarely discuss is cash flow, and that omission is fatal. Valuations are not philosophical concepts. They are grounded in cold reality. If you aren't doing the math, you aren't investing, you're participating in a popularity contest. Popularity contests end quickly. Economics endures. And when sentiment shifts, as it always does, the companies that were priced like gods suddenly find themselves treated like mortals. A business that traded at some heroic multiple last year becomes a cautionary tale this year, not because the technology failed, but because the price was untethered from reality. The dot-com bubble taught us that the market can stay irrational for a while, but not indefinitely. The AI bubble will likely teach the same lesson, only on a grander scale. The companies that deserve their valuations will eventually prove it through consistent, defensible profits. The ones that don't will vanish with astonishing speed. All the storytelling in the world won't save a business that can't do basic arithmetic. And for investors who forget this, the correction will be a very expensive refresher course. ChatGPT said, "Incentives are the invisible hands that tug at human behavior, and most of the time those hands are not gentle nudges but forceful shoves." If you want to understand why people act foolishly during a technological boom, don't bother analyzing their public statements, examine what rewards they're chasing. The moment a new technology becomes fashionable, everyone in the ecosystem develops an incentive to exaggerate. Founders exaggerate their progress, investors exaggerate their conviction, analysts exaggerate their expertise, and the media exaggerates everything because exaggeration pays better than accuracy. This isn't a moral failure, it's a structural one. When someone stands to profit handsomely from hype, you should expect more hype than honesty. That's been true for centuries. It was true during the railroads, the radio boom, the semiconductor revolution, and the dot-com era. If you look closely, you could practically see the incentives swelling like balloons. When a founder realizes that adding AI powered to a pitch deck unlocks money they couldn't get yesterday, you don't need to wonder why they suddenly become evangelists for a technology they barely understand. They're simply following the carrot dangling in front of them. What people rarely appreciate is how incentives warp not just actions, but thinking. The mind is an expert contortionist. It bends to justify whatever rewards are nearby. If a venture capitalist knows their limited partners crave AI opportunities, they start seeing promise in companies that would have looked ridiculous 6 months earlier. If an executive notices their competitors announcing an AI strategy, they begin believing they need one too, even if the core business has nothing to do with AI. Suddenly, every boardroom discussion morphs into a performance about leveraging data and unlocking synergies. Nobody wants to be the lone person who says, "This makes no sense," because the incentive structures punish skepticism and reward enthusiasm. If you've ever wondered why bubbles grow so rapidly, it's because almost every participant is encouraged explicitly or implicitly to inflate them. You get more praise for joining the parade than for pointing out the cliff it's marching toward. This dynamic becomes even more absurd when media incentives are added to the pile. Outlets know that stories about technological breakthroughs attract more attention than boring but accurate analyses. So they dramatize every announcement, glorify every demo, and frame every milestone as the dawn of a new civilization. Once that kind of storytelling circulates widely enough, it becomes its own incentive. Professionals start echoing the narrative not because it's true, but because it's profitable. Before long, the ecosystem resembles a hall of mirrors, everyone amplifying everyone else's exaggerations until reality becomes unrecognizable. And when reality finally intrudes, as it always does, people act shocked, as though the collapse came out of nowhere. But collapses never come out of nowhere. They come out of distorted incentives. Eventually, of course, the corrective mechanisms of the world reassert themselves. A bubble inflated by bad incentives doesn't continue forever because the laws of economics are less flexible than human imagination. Yet the blame rarely falls on incentives. People prefer scapegoats. They blame the technology. They blame the regulators. They blame unforeseeable conditions. They never blame their own susceptibility to rewards that encouraged every bad decision along the way. If you want to avoid participating in the next disaster, learn to look at incentives the way a biologist studies pathogens. Treat them as forces that modify behavior, mutate intentions, and spread from person to person. Once you understand that, everything that looks irrational suddenly becomes perfectly predictable. That brings us to the next point, because if incentives fuel bubbles, impatience accelerates them. Real innovation is slow, painfully slow. It does not move at the pace of hype cycles or quarterly earnings or social media timelines. It moves at the pace of experimentation, iteration, mistakes, dead ends, and gradual refinement. That's the real rhythm of progress, and it's about as exciting to most people as watching paint dry. Nobody likes to admit this because patience doesn't sell. What sells are promises of instant transformation. And during boom cycles, everyone pretends the slow, grinding nature of innovation has suddenly disappeared. They act as though technological history has entered a magical era where breakthroughs happen on demand like room service. The truth is far less glamorous. Every genuine breakthrough rests on thousands of unglamorous steps. The early internet didn't deliver the value people imagined during the dot-com frenzy. That value only became apparent decades later. Cloud computing didn't revolutionize everything the moment it was invented. It took years of infrastructure, standards, and adoption before its power became unavoidable. The same will be true for AI. The technology is genuinely extraordinary, but the distance between extraordinary idea and extraordinary business is vast. You don't bridge that gap with press releases about revolutionary potential. You bridge it with real products, real customers, and real margins. And building those takes time, more time than impatient investors, anxious executives, and excitable commentators are willing to admit. This mismatch between the pace of innovation and the pace of speculation creates a dangerous illusion. People start believing that because progress appears rapid on conference stages and keynote slides, the underlying reality must be equally fast. They forget that prototypes and demos are not the same as scalable, profitable systems. It's easy to produce a video showing AI doing something impressive. It's hard to produce a business that consistently earns money from it. And yet, in every bubble, investors behave as though the hard part is already done. They treat future dominance as though it's guaranteed, ignoring the long, difficult road that separates a promising technology from widespread, dependable value creation. The impatient mind hates uncertainty, so it fills the gaps with fantasy. And nothing fuels fantasy like early success stories. A few companies execute brilliantly, and suddenly everyone assumes the entire sector is destined for unstoppable triumph. This is how you get waves of copycats building slightly altered versions of the same idea, all convinced that their minor twist will lead to glory. What you really see is a parade of impatience, people trying to skip the slow work of discovering genuine value and instead riding the momentum of early winners. But momentum is not a substitute for substance. When the market eventually shifts from storytelling to scrutiny, impatience is punished ruthlessly. Companies that built their hopes on hype instead of durability fall apart almost instantly. The irony is that slow-moving innovation often produces the most enduring riches. The firms that keep their heads down, focus on fundamentals, and ignore the mania tend to emerge far stronger than the ones shouting from rooftops about disruption. They aren't trying to impress investors with theatrics or ride the tailwind of public excitement. They are simply building, refining, and improving, quietly accumulating competitive advantages while everyone else chases shortcuts. Over time, this patience compounds. While hype-driven companies burn out, the disciplined ones become indispensable. But that moment of clarity usually arrives long after the crowd has exhausted itself. If you truly want to understand how technological revolutions unfold, stop listening to the noise and study the timelines of past breakthroughs. They all share the same pattern: initial excitement, unrealistic expectations, painful correction, slow rebuilding, and eventual dominance by the few players who survive the turbulence by embracing patience and discipline. That cycle is older than any technology and smarter than any human. When you respect it, you avoid joining the herd in its sprints toward cliffs. When you ignore it, you end up as collateral damage in the next correction. Human nature, for all its lofty pretensions, has never truly evolved. We invent dazzling technologies, build towering civilizations, and congratulate ourselves on our sophistication, but underneath the polished surface, we remain driven by the same old impulses that governed us when we were bartering grain and sharpening spears. Greed, fear, envy, overconfidence, these are the ancient operating systems running inside modern hardware. And while technology upgrades itself every few months, human psychology still runs on a version carved somewhere between the Stone Age and the marketplaces of ancient Athens. This is why bubbles repeat. This is why mistakes repeat. This is why investors, despite possessing more data and better tools than any generation before them, still behave as if they're crowding into a tent to watch a traveling magician pull rabbits out of hats. Tools don't erase tendencies. They simply magnify them. Once a person becomes emotionally excited, they stop thinking and start reacting. And reactions are predictable. You show someone a chart that goes up quickly, and their mind leaps to the conclusion that it will continue upward indefinitely. This is not rational analysis, it's instinctual extrapolation. The same instinct that once helped humans anticipate the movement of prey, now it helps them overpay for technology stocks. You whisper a rumor that a new tool is going to change everything, and suddenly people begin buying with the urgency of a shopper during a clearance sale. It's not because they've discovered a sober, evidence-based thesis. It's because they can't tolerate the thought that someone else might get rich while they stand by. Envy is one of the most corrosive forces in human behavior. It causes investors to abandon their own principles simply because they don't want to feel like the only person missing the party. If people were driven by logic instead of emotion, bubbles would evaporate overnight. But human beings are storytellers long before they are mathematicians. They build narratives to soothe themselves, justify their actions, and silence their doubts. During every speculative frenzy, the narrative becomes something like this: "This time is different." Those 4 words have probably destroyed more wealth than all the recessions combined. They allow people to cling to delusions with remarkable determination. They encourage investors to believe they've escaped the limitations imposed on previous generations. They create an illusion of personal brilliance, as though they've stumbled upon a secret invisible to ordinary minds. And once a person feels brilliant, It's almost impossible to convince them to be cautious. The problem is that technology makes delusion easier. The more complex a system appears, the easier it becomes for people to claim it's beyond old rules. In earlier centuries, speculation revolved around things like tulip bulbs or land, which at least had the virtue of being simple enough for most people to understand. Now we have artificial intelligence, a field so intricate that even experts disagree about its boundaries. This complexity gives amateurs a convenient excuse. If they don't understand it, it must be profound. So they project all sorts of magical qualities onto it. They imagine it can solve every problem, disrupt every business, and obliterate every competitor. In their minds, the technology becomes invincible not because it actually is, but because overconfidence requires little evidence and zero humility. Overconfidence is another of those timeless psychological traps. Once someone has made one successful prediction or experienced one good quarter, they begin believing they possess special insight. They forget that luck, timing, and randomness often play bigger roles in success than brilliance. They assume the future will reward them in the same way as the past. And when you combine this overconfidence with the high-speed environment of modern markets, you get a perfect storm. People begin investing aggressively, leveraging themselves recklessly, and justifying valuations that would have embarrassed a gambler in Monte Carlo. They become certain their judgment is superior to everyone else's, and certainty is often the most dangerous state of mind in finance. Human beings also love social validation. Most people would rather be wrong with a crowd than correct in isolation. This tendency fuels the herd behavior that accelerates bubbles. Once enough people start believing in a trend, the rest follow not because they examined the evidence, but because they assume the crowd must know something they don't. The tragedy is that crowds are rarely wise in moments of excitement. They are impulsive and emotional, quick to chase after shiny possibilities and equally quick to panic when things turn sour. The same crowd that drives valuations sky high during the boom turns into a stampede during the bust. You can almost set your watch by it. This brings us naturally to the final keynote, because while human nature is slow to learn, the markets are quick to punish. Preparing for the crash is not pessimism, it's realism. Every bubble is followed by a correction, and every correction creates an environment where rationality becomes profitable again. But most people don't prepare for the crash because preparation feels like admitting the party will end. They prefer to believe that the music will keep playing as long as they dance energetically enough. Unfortunately, markets are not run by DJs taking requests. They are governed by the cold mathematics of value, and when the math resumes control, the dancing stops abruptly. Those who have prepared can walk through the aftermath unscathed, even opportunistic. Those who have not prepared find themselves stunned, confused, and poorer. Preparing for a crash means maintaining discipline during the boom. It means resisting the temptation to overpay just because everyone else is doing it. It means recognizing that technology, no matter how impressive, does not justify abandoning fundamental analysis. It means building a margin of safety into your decisions, something investors talk about endlessly and practice rarely. The margin of safety is not just a financial concept, it's a psychological one. It protects you not only from market volatility, but from your own worst impulses. It forces you to remain sensible when others are euphoric and to remain patient when others are frantic. Most investors fail precisely because they let moods determine their strategies. They buy when they're excited and sell when they're frightened, which is essentially a recipe for transferring money to those who behave the opposite. When a crash finally arrives, the field clears dramatically. Overvalued companies that relied on hype instead of substance disappear almost overnight. Weak business models evaporate. Startups that claimed to be revolutionary but had nothing but slogans shut their doors quietly. What remains are the companies that actually created value, the ones patiently building, refining, and proving themselves, while others were making noise. These survivors often become astonishing bargains because the market tends to overcorrect in both directions. Just as valuations become irrationally high during the boom, they can become irrationally low during the bust. For an investor with discipline, liquidity, and courage, this is the moment that builds fortunes. It's important to understand that thriving after a crash is not about celebrating destruction. It's about recognizing the cycle of excess and sobriety that governs human affairs. People grow overconfident, push valuations too far, and then overreact in the opposite direction. The investor who keeps a cool head during both phases is the one who ends up owning the world while others are busy licking their wounds. But maintaining this cool head requires preparing before the crash. You don't buy fire insurance while the house is burning. And you don't build financial resilience when the market is already collapsing. You build it when things are calm enough that nobody else cares about safety. That's the paradox of prudence. It feels unnecessary until the moment it becomes essential. Most people never learn this because they rely on emotion instead of principle. They chase excitement instead of value. They let their instincts guide them straight into disasters that could have been avoided with a little foresight. But those who understand the rhythm of human folly can navigate it, profit from it, and even find a strange kind of amusement in how predictable it is. There's a certain advantage in recognizing that while technology may change, people rarely do. And if people don't change, neither do the cycles they create. This awareness doesn't make you cynical. It makes you prepared. It teaches you that the smartest path is rarely the most glamorous one. It reminds you to keep your head when others are losing theirs. It helps you see that every boom carries within it the seeds of its own unraveling, and every bust contains hidden opportunities that only patience and discipline can uncover. In a world intoxicated by speed, shortcuts, and excitement, the person who understands the slow, steady cadence of reality is the one who consistently comes out ahead.